Millions of entrepreneurs will go online this year, pay $150 to a legal website, and think they've built an impenetrable fortress around their personal wealth. But if you're starting an LLC in 2026, I have a harsh reality for you. The IRS and hungry trial lawyers will tear through about 90% of those LLCs in about 5 minutes. As a tax and wealth strategist, I'm here to tell you that setting up an entity is only 10% of the battle. So today, I'll break down the 5 most expensive mistakes business owners make when starting an LLC in 2026, and exactly how you can avoid them. Welcome to Taxes Shmaxes. If you're new to this channel, I'm Edward Nisanov, President and CEO of Nisanov Tax Group, and I've been advising on tax strategies for over 20 years. You might have seen us in Forbes, Yahoo, and Newsweek. And on this channel, I give you the blueprint for total wealth management, from maximizing your portfolio and slashing your tax bill to advanced estate and passive income strategies. Make sure you subscribe and hit that bell notification so you never miss a strategy to level up your net worth. Now, mistake number 1 is falling for the out-of-state mirage. You've seen the TikTok, some guru tells you start your LLC in Wyoming or Nevada because there's no state income tax. Sure, while that's true, the reality is that the IRS is still going to tax you where the money is earned and where you physically work, as well as the state that you're located in. So if you live in New York and have a Wyoming LLC, you still pay New York taxes. Plus, you've just created additional foreign entity registration requirements to the states outside of where you registered. So you end up paying double the tax filing fees and having to file additional annual reports. If you form your operating business in the state where you actually live and work, that will smooth the process and give you less headaches and administrative burdens. Now, mistake number 2 is the fastest way to lose everything: commingling your funds. When you create an LLC, you're creating a separate legal person. But the moment you use your new business debit card to pay for your personal groceries, your Netflix subscription, or your kids' daycare, you've just committed the ultimate sin. That exposes you to piercing the corporate veil. Can't commingle funds, guys. Can't use personal expenses through your business. If you get sued and a judge sees mixed funds, they'll rule the LLC as a sham, and your personal house, truck, and savings are now totally exposed in that lawsuit. That's from the legal side. From the tax side, maybe even worse. Any distributions you take may be taxed at a different rate. Everything can be thrown out, and all of a sudden, because you're commingling business and personal, all those, not just legal shields, but the tax shields and protections are no longer there. You want to make sure that you pay attention to how you spend money inside of your business. Make sure you document things under certain accountable plans if you're reimbursing yourself for personal payments for business expenses. It's super easy to do when you have the right systems in place. What you need to keep in mind is that the day that the LLC is approved, you open up a dedicated business checking account. Absolute brick wall between business and personal cash. And that's the fix. Mistake number 3, you're operating an empty shell. You went on a cheap online website and you got your articles of organization. And you think, all right, great, done, all set. The reality is that that document just says that you exist. It doesn't prove how you operate. Remember, you have to have an operating agreement. It dictates ownership, profit splits, and all the rules to abide by within the business. And without it, the state defaults to its own generic laws during a dispute. And those laws rarely favor the business owner as well as the intent that you have when structuring that business. If you're going into business with third parties, and it's not just a single-member LLC or a sole shareholder, S or C corporation, make sure to get all this stuff in writing. Because you guys, I understand, trust each other. Of course, you wouldn't be going into business if you didn't think you can trust each other. But I've seen in my experience is that you must put everything in writing, because as time goes on, memories get fuzzy and you may not remember what you agreed to when you first formed that entity. So make sure to have everything written down so we're all clear. Mistake number 4. Now it separates the amateurs from our scaling builders. And the biggest mistake you can make is staying a single-member LLC when you're making real money in certain situations. Now, I talk about this a lot, And we always have to run those scenarios and scrutinize the numbers. You hear a lot, make the S-Corp election. Become an S. No reason to be a single-member LLC. That may be true in some cases, but sometimes it's not, especially in certain jurisdictions like New York City and California, where you still have a pretty significant entity-level tax. So let's get into this a little further. If you're a single-member LLC, you're paying regular income tax on the net income of the business. Plus, because you're reporting income on your Schedule C, you're paying a 15.3 self-employment tax on every dollar you make up to the Social Security cap, which is about $200,000. Anything above that, you're still paying either 2.9% Medicare tax, or above that, whether you're 200,000 single or 250 married, you're paying an additional 0.09%, which is another 1% of Medicare tax above that. So in total, you're paying over 16% potentially in FICA taxes. Now, what the S-Corp election does is move income into an entity called an S-Corporation. And what that actually does is bifurcates all the income going to you. So in an S-Corporation, you have to bifurcate net income to the owners. So through the S-Corp election, you essentially are in control of the FICA tax. Here's the hack. Income flowing through to you as the 2% or greater shareholder that materially participates in the business is the only item of income or salary that is subject to FICA tax. The rest of the net income that you can either take out or not is not subject to FICA tax, but it is subject to income tax. That's the only caveat. So instead of paying the entire 15.3% plus the additional Medicare of 0.09 on the entire income that's coming through to you, you're in control of it to an extent and are only paying it on that W-2 piece. So let's illustrate this in real terms. Let's say you're a business owner and you are making top line revenue of $1 million. Your bottom line revenue is $300,000. So if you were reporting this on a Schedule C, the entire $300,000 would be flowing through to you at not just the ordinary income tax rate, but at 15.3% up to the Social Security cap, plus the 2.9 and the additional 0.9% Medicare. So the entire amount is exposed to self-employment tax. Now let's say you make an S-Corp election for this business. Now you are essentially in control of bifurcating that income. And let's look at it again. We'd have to look to see what you're doing as a profession to see what your reasonable compensation is in that business. And what's reasonable compensation? You can look at it and say, well, what would it cost me to hire somebody to do the job that I am doing as a business owner, right? So let's say for this business, the going rate for somebody at this level is $140,000 a year. So what you've essentially done is sheltered $160,000 of that income away from FICA tax and are only paying the tax, the 15.3%, on that $140,000. Pretty powerful tool if you know how to do it right. Plus, not part of this video, but I'm gonna throw this in for you guys because I love you guys. So this is what I'm gonna share with you. Not just that, when you elect S Corporation, you actually open yourself up to a lot more deductions because of that corporate entity structure. For example, the PTT election is now available to you. The Augusta rule is now available to you. Accountable plans are now available to you. And the list keeps going on. But this is something that you have to sit down with your tax advisor to figure out, hey, what benefits am I losing by remaining a single member LLC? And what am I gaining by converting into an S corporation? Sometimes, again, depending on the state that you're operating in, it's not an even trade-off. So just wanted to give that out to you. Now, back to our regularly scheduled program. And finally, this is what I call the all-in-one asset trap. And it's exactly how successful business owners lose their entire empire, potentially overnight. A basic tax preparer will let you put everything you own, that machinery, the equipment, your trucks, your commercial real estate, and that $150,000 excavator directly into one LLC. The same LLC that signs your client contracts and that does the operations. But that operating LLC is on the front lines, taking 100% of the legal risk. Now, if a job goes sideways and a massive lawsuit hits, every single asset inside that company is now fair game from the friends or not so much friends on the other side of that aisle. Now, again, this is not legal advice, and I would speak to your attorney about this, but you have to be careful when you're structuring entities we're not only looking from the tax perspective, well, we are looking from a tax perspective as far as benefits go, but we have to work alongside your attorney and legal team to make sure that what we're structuring is also protecting you from asset exposure. Because that, unfortunately, in the litigious society that we're living in and working in right now, is a potential risk. So we always have to make sure that whenever we're structuring, we do it the right way and not just on a legal website for $150, because it may definitely cost more in the long run. So what do we do here? We pivot. This is the difference between working with a strategist and a general preparer. So we'll look at a potential 2 LLC structure. And what we'd set up is a holding company that's going to hold your heavy equipment, your vehicles, your expensive assets, and that LLC has no public persona. It just holds the assets. And you're gonna set up your operating LLC that's gonna deal with the public, deal with the contracts, deal with your clients. And the structure is gonna be where the holding company is gonna lease the equipment back to the operating company. So the operating company owns nothing, the holding companies own everything from an asset perspective, and you just work back and forth. And because of grouping rules, you're able to essentially take advantage of depreciation and everything else that we usually talk about on this channel. And the best part is, because they're separate entities, you will legally be able to bifurcate those assets. So keep that in mind. Now, to recap, you register your business in the state where you actually perform the work. You don't commingle your funds, you don't run an empty shell, and you avoid the all-in-one asset trap. And don't forget, stop tipping the IRS an extra 15.3%. It's like an automatic tip button on a check. You don't want to do that. So if you're a scaling entrepreneur and you're ready to stop leaving money on the table, it's time to upgrade your team. Click the link in the description below to book a complimentary tax strategy session with Nisanov Tax Group. We'll take a look at your current business structure, identify where you're leaking money, and build a custom blueprint to preserve your wealth. If you like this video, check out these other, not sure where it is, somewhere here, these other wealth management strategies next. Okay, go ahead, come on, click here now. It's not gonna click itself.